Now let's talk about the identification. There are 3 rules of identifying. The first rule is the 3 property rule, where you're physically limited to 3 addresses, but you're not limited to dollar amount. The next rule is the 200% rule. Under the 200% rule, you can identify 4 or more properties. However, the fair market values of all of those properties cannot exceed 200% of your sale price. And then there's the third and final rule, which is the 95% rule, which means you can identify 4 or more properties. The fair market values exceed 200% of your sale price. However, you need to close on 95% of the total of all the values of the properties identified. So so when we talk about this, when we talk about the identification rules, it's really important for the investor to understand what rule they're going to be able to use. So when I'm speaking to somebody, I'm in the Los Angeles area. So when I speak to somebody that's selling in Los Angeles, and they say, well, they're going to buy a replacement property in Los Angeles, and let's say the sale price is $700,000. Well, given the fact that the sale price is $700,000, they're going to say buying in Los Angeles, they're not going to be able to use the 200% rule, because 4 properties is going to blow apart the 1.4 million. So, but they're going to be able to use the 3 property rule. But if I'm selling in Los Angeles, and say I wanted to buy in Tampa, Florida, or Jacksonville, or if I wanted to buy in Houston, Texas, where maybe the prices are $150,000, $200,000, with a $700,000 sale, I can easily use a 200% rule and identify up to $1.4 million. So the rule that you're going to be able to use in your transaction is going to be dictated by how much you're selling for and where you plan on purchasing. Very few people are ever going to use a 95% rule, because that's an extremely dangerous rule to use, because basically you would have to close on all of the properties that you've identified. Now, when we talk about identifying, I like to say that there's a technical and the practical. So the technical is going to be, yep, here we go. The technical is going to be that you are going to, bear with me for a second. The delay time is a little bit harsh here. Just spare me 1 second. Because what I'm trying to show you right at this point is what the identification form looks like. And this is the form that when you're doing an exchange, you're going to fill out. We as a qualified intermediary are going to provide you with that form. So the technical aspects of the identifying is going to be that you fill out the ID form. The practical aspect would be that you should be under contract with a property or properties that you're going to be putting on that form, because you can only purchase the properties that have been identified on the identification form itself. Okay, so be very aware of this. You cannot change your identification form after the 45th day. Most people are not going to fill out this form until you get closer to the identification period. So when we talk about identifying, let's talk about the 3 property rules. So when you're filling out the form, you're going to put in the city, the name, the address, the city, and the state. So here's an illustration. I've got 3 properties here, 123 Main Street, Jacksonville, Florida. Correct. I've got address, city, state. The next one I've got address, city, state. The third one I have the address and the city, but I don't have the state. So that's incorrect. I have to make sure that I'm going to put the state in there, because am I talking about Norco, California, or am I talking about Norco, Louisiana? So address, city, state. If it's not done properly, it's not identified properly. If you're going to be buying property with someone else, say it's tenants in common or joint tenants, you're going to be putting in the percentage that you're going on title to. Again, we're getting into the fine tuning of this information here, but the identification is critical to the success of the exchange. And this form has to be done correctly in order for the exchange to be valid. If you're identifying 200%, This is when you're going to fill in the dollar amounts. So I have, in this example here, I have 5 properties and I'm putting the dollar amounts. Now people go, well, what dollar amount do I put? Well, you'd have to put the fair market values of the properties. And one of the things that's really important to understand is that if you're putting down on the identification rule that the property was 200,000, but you end up buying it for 250, that's not considered like kind because it's not substantially the same. So you're going to have to watch in the 200% rule these dollar amounts. But in my example here, most of the time what you're going to be using is either the asking price or your offering price to put that in there. You're going to fill in the dollar amounts, add them up. So if I sold for 500,000, when I add all of this up, it's 995. I've met the 200% requirement because I'm at 200 or below. What that means is I can buy whatever value, whatever properties I want to meet my exchange value of $500,000. So there's flexibility in the 3 property rule for not having to buy all the properties, the same as flexibility in the 200% rule. When you get to the 95% rule, you would have to buy all those properties. Now, let me take you to what's going on in today's market. There are times where people are looking to either consolidate or they're looking to buy more. So let's talk about the consolidation side. When you're doing an exchange, if you wanted to sell multiple properties to buy one, so maybe I have several single family rentals that I want to sell. Maybe now as an investor, I want to buy an apartment building and I need 3 properties to sell to buy that apartment building. You can do a multiple property exchange where I'm including 3 different sales to buy 1 property. What's important to understand in this type of transaction is that the time frame for the exchange is going to officially begin at the closing of the first property. So the minute the first property closes, that starts the time frame for both the sale 2 and sale 3. So you want to make sure if you're doing something like this, that properties 2 and 3 are going to close as close together as they can to make you less stressed, for one thing, in order for you to have all the funds to buy the replacement property. Very tricky transaction, especially if you're selling across multiple state lines and dealing with multiple agents along the way. It's doable, but you really have to pay attention to what's going on and making sure that you're in position with all the properties that are involved. Now, what's quite common right now is selling 1 property and buying multiple properties. The key here is that you're having to identify all the properties that you want to buy, and you have to close on that last purchase by the 180th day. So multiple property exchanges, both sale and purchase, are done all the time. You just have to be aware of the timing of everything that you have going on. Okay, so let's talk about things that are happening in my world right now. Financing. When you're considering doing a 1031 tax deferred exchange, it's very important that you're bringing in the lender to find out, especially when you're doing planning on what you're buying, to find out how's your financing going to work on these transactions, to make sure that the way you're holding title to the property is going to work with the lender. So get this financing lined up. Understand what the lender is going to be requiring. There are instances in an exchange where what the lender requires and what a 1031 can do does not match. As an example, there was a transaction where an investor was selling a property, had the exchange, buying the replacement property. The financing required that the exchanger pay off a car loan. They were willing to have the lender was willing to have that car loan be paid off at the closing and the funding of the transaction. Well, the problem with that is you can't use exchange proceeds to pay off a car loan. So again, this is why it's important to bring in the lenders early so you understand what your financing is going to look like on the replacement property side. The next items we come up with, and I talked a little bit about this before, and that is the exchange entities investing. If you're selling a property and it's in your individual name, but you want to purchase a replacement property in an LLC, or you want to purchase the replacement property in a trust, as long as that LLC that you're creating and the trust that you're creating is disregarded or is the same taxpayer that's sold, then you're fine. What you cannot do is sell as an individual and buy in a partnership. That will not work. So again, watch your vesting when you're selling and buying properties. We talk about partial exchanges. So let's talk about what that is. I'm seeing today on transactions where investors are selling, and what they would like to do is keep some cash in reserves. I mean, we're definitely in interesting times for property ownership. So maybe they want to keep some cash in reserves, and this is reserves above and beyond what the lender may be requiring. So I want to hold some money back. Can I do a partial exchange? The answer to that is yes, you can. But what's important is to understand if you're keeping too much money out and not benefiting from the exchange. If you're wanting to keep, for example, $50,000 out of the transaction so you can have some reserves, if your gain on the sale of that property is, say, $100,000, then you would still be benefiting from the exchange because you'd still be protecting tax on that other $50,000. But if you wanted to take $50,000 out and your gain on the sale of the property was only $40,000, then there would be no benefit for you to do an exchange because you would pay all the tax as though you didn't facilitate an exchange. So partial exchanges are doable. We're seeing them happen. So when you're having these discussions, think about the numbers, find out what the tax consequences are. Sometimes people are using partial exchanges because maybe they have a small loss carryover. This is a way they can release some cash without having a taxable event. Again, the importance of talking to the tax advisor. Other components in an exchange, you must hold the property for investment purposes. So if your intention is to buy a property to fix it up and sell it, you're considered a dealer, not an investor. So that does not qualify for the exchange. Because one of the components come in, well, how long do I have to hold the property for it to be declared held for investment? Well, there's nothing in the code that mandates a specific holding period, but it's about the taxpayer's intent. So if my intent is to buy this property, fix it up and sell it, then my intent is not to be an investor. I'm considered a dealer. I can be an investor and maybe only hold the property for a year. So there's no mandatory holding period, but it's what is my intent? Who's going to answer that question? The tax advisor. Did the taxpayer have the intent to hold that property for investment purposes? So while there's no mandated holding period, the intent to hold the property still has to be met. Reverse exchange, that's a product that is available, not always doable. So when we talk about reverse exchanges, that means that a taxpayer has to close on the purchase before they have closed on the sale. When you do something like that, the taxpayer cannot be on title to both properties at the same time. So the qualified intermediary is going to create an LLC, and we're going to park title to the property. This is an expensive exchange because of the nature of what's going on. They're very difficult to do in the sense if there's financing involved, because not all lenders will allow the qualified intermediary to go on title to the property. So if you are considering a reverse exchange, before you start negotiating any kind of contracts on this, it's important to have a discussion with somebody like me who's going to take you through the details. We're going to go over the economic values of doing a reverse exchange, and we're going to weigh it out to whether it makes sense or not. So while they're available, they're not always doable. So just keep that in mind. And the other component, it's been around since 2014. I still like to bring it up because investors who are selling out of California, selling from California and investing in other states, there is a mandated reporting. It's the FTB 3840. That means you've deferred tax to the state of California, So every year that you own property out of the state, you have to report that you still own that property. If you fail to report, then the Franchise Tax Board could assess you tax on what they say you owe from the sale of the property from California to another state. They do monitor this, and they will send out notification. So it is a reporting that you have to have when you're dealing with the exchanging outside of the state.